You want to talk about grocery stores?
Yeah, talk about exciting.
Yeah. Well, we went from Netflix, Disney to a grocery store. But again, grocery stores, I think, they're going to be around, whether it's going to be delivery. I mean, I see a lot more when I pull up to the grocery store, for delivery only pickup and stuff. So they are keeping up with the times. But we're talking about Albertsons companies. I think they own Safeway and Bonds. Yeah, they and the Albertson name. Symbol ACI, then the grocery store industry, 4% float on the short side, no problem there. Nice PE ratio compared to the entertainment companies, 13.5. Nothing for the industry there. Price to sales, 0.2. That's very good. Price to book value, 3.8. That is above the industry at 2.8. Price to cash flow, this is a phenomenal number compared to the industry, 4.8. Almost 1/10 of the industry at 41.9. And the PEG ratio, very good, 1.4 versus 6.9. Now, for some reason, it could be with all the potential acquisitions, mergers that they've been going through the last year, their earnings are down 26.5% when the industry is up 11.4. And I want to know why. I was going to buy Albertsons. Why? That seems out of line. Sales are up 1.5%, while the industry was down 0.7%. 5-year earnings per share growth rate from the analysts, 8% versus 8.3. That is fine. They pay a pretty decent dividend, 2.7%, and only use about 31% of their earnings to pay that out, so I'm very comfortable with that. Taking a look at the balance sheet here, they got a current ratio of 0.9 versus 1 for the industry, and that's okay. Debt to equity looks strange, 4.2 versus 1.6. I'm wondering if they took on debt to do these acquisitions. They're going to try Kroger's, was it? I forget who.
No, it was that Kroger was going to buy them.
By them. Oh, well, that could have been good for Albertsons with all that debt. I'll take a look at the balance sheet when you're looking at your numbers. But 4.2 is very high debt to equity. We do see a net profit margin 1.2, industry 1.9. Again, grocery stores do have a very thin profit margin, but a lot of turnover is what they get, a lot of sales there. Return on equity, that's why you look at return on equity, 28.3 versus 14.8. Free cash flow number, not very good, $749 million versus $2.2 billion for the industry. So I'm getting a little bit nervous here. What do you got?
Yeah, well, current price here for Albertsons companies, it's $21.91. The 52-week range, stock's actually done, I'm going to say okay. And I was curious about this because I did see it go across the ticker tape, but Kroger's like right near an all-time high.
Yeah.
So I think people kind of are happy maybe that Kroger didn't buy Albertsons because that stock's been performing phenomenally. I'm like, I'm curious how Albertsons is doing. But 1 year return, it's up about 10%. Year to date, it's done, again, okay, up about 10% given all the volatility. But going forward for Albertsons, we go out to February 2027. They report on a fiscal basis, $2.24. Gives us a target sell price here at $37.18. I mean, that's quite attractive. A forward PE multiple around 10 times. As I said, we like to buy companies around 12 times earnings.
Right.
So at 10 times, I mean, that's attractive. As you said, the big problem here, that balance sheet, I know you had that, but I did want to say of intrigue here, a reason Albertsons was interesting was the grocery store actually dropped about 8%. The stock did after they issued full year guidance that was below expectations. Company estimates adjusted earnings between $2.03 and $2.16. Analysts were looking for $2.28. So I'm curious why that business is maybe struggling a little bit more than potentially other grocers out there.
And just on the balance sheet real quick, cash, only have $294 million of cash here. Let me scroll down a little bit because I want to look at the debt. Where's the debt? Long-term debt, $13.4 billion. And that seems like it's been that way for a while. So I don't know why they carry so much debt. Their equity is only $3.4 billion. So they're really upside down here.
Well, and remember, obviously they bought Safeway, and Safeway owned Vons. So I mean, there's kind of been this trickle down effect essentially of maybe all this debt getting compiled by all these acquisitions. And Albertsons was private for years, and then they became public again. I think it was just a couple years ago. So I mean, the stock journey for Albertsons has been quite intriguing, and I'm going to say while some of the numbers look interesting here, I just don't think you can buy it. I think that debt is such a burden. And you talk about Walmart, you talk about Costco, you talk about Amazon wanting to get more into groceries. I think this would be an interesting company if the debt was cleaner. But if you are wrong and Albertsons struggles further against those competitors, I mean, this company goes bankrupt because they can't keep up with that debt burden.
You know, and even going back to 2021, even back then, they had debt of $13.4 billion. So it's about the same. It did dip a little bit in 2022, but then it went right back up again. So these grocery stores, that's one thing I don't like. At least this one. We should maybe next week look at Kroger, but I don't like companies carry a lot of debt because if things go the wrong direction, you still got to pay the interest on that debt. And that can cause problems to where now you have to start using your liquidity, then you can't pay the interest on your bonds. All of a sudden, you're forced into bankruptcy.
Yeah, and I don't know either how this, I'm going to call it MAHA, the Make America Healthy Again movement from, you know.
Maha. What is that?
MAHA.
Yeah, it sounds like something from the Caribbean or something.
No, from RFK Jr. is, I'm curious how that impacts an Albertsons. You know, and I say that because, you know, like my wife, she likes to shop at Sprouts. She likes to shop at Jimbo's. She doesn't love to go to an Albertsons. She likes to kind of shop at those organic, healthier places. And I don't know if that movement, is that going to impact an Albertsons grocery store? I know they carry some of the, you know, healthier alternatives, but is it easier to go shopping at the other locations if you are involved in that kind of movement, I'm going to call it?
And I kind of want to, I mean, RFK's been kind of quiet. I haven't heard much about him.
I mean, the only thing I did see is they are pushing to, again, remove those red food dyes from the big companies there. So, I mean, there's been kind of small things kind of percolating out there. So, you know, we'll have to see, and we'll see if that movement carries on. But if it was an issue, I mean, the GLP-1s, is that going to impact an Albertsons? Because are people going to need to buy less food? You know, there's some questions I would have about this company in relation to you know, kind of the health of our country and those obesity drugs, which, again, are definitely growing a little bit more in prevalence.
And to let people know, this is the type of company that we do like.
Yeah.
But we like to have low debt, and we like to pay a reasonable price for it, which, unfortunately, that's not here.
Yeah, and the reason we like these types of companies is because they do kind of go against the grain, obviously, but if you're wrong on a value stock, you want to make sure that the balance sheet is okay enough that you're not going to lose everything. Because if you buy a company because of the valuations and then your thesis is wrong, let's say, and they have a terrible balance sheet, well, now maybe you didn't take a 20% hit on the stock. You lost everything because the company went bankrupt.
Exactly. That's why we give you these numbers, and and again, we do this live. We don't pre-look at the numbers before we come on the air. We actually look at them live. So we don't know what we're going to see until we see it. So you're getting our initial reaction of what we'd actually do here. So